you believe that China is not uninvestable, and it looks like you're not the only one with that view, given the fact that the Chinese market has come off its early February lows and is trying to find some kind of stabilization. What's the case?
Yeah, I mean, for the equity market, the case is that so many people are so negative on China, and valuations are relatively cheap. I mean, that's the main case for China. I mean, Q1 GDP was good. I mean, there were parts of it that were pretty good, parts of it that were still soft. The external facing side, look, we were talking about the US potentially not cutting interest rates this year. Part of that is because the economy is doing so well and China's benefiting in terms of the export side. But I'm actually looking a little bit more about the fixed income, the credit side, the government bond yield side. And you could probably call me crazy for wanting to buy 10-year Chinese government bonds at 2.25%. But if you do think that China is the credit side is decreasing, so they're borrowing less. They're going to be creating fewer currency, fewer renminbi. They need to keep cutting interest rates. Monetary policy needs to be looser and looser and looser to try and get themselves out of the Japanification. I suspect yields in China are going to continue to go down, and buying 10-year Chinese government bonds at 2.25% might not seem that silly over the medium term.
And could we also see an appreciation of the Chinese yuan as a result?
Yeah, so again, this is very not in consensus. I think a lot of people think that the Chinese currency will depreciate. And against the dollar, it has, of course, it's been weakening. But on a trade-weighted basis, it's been going up and up and up. And it's only been stronger for a few months in the last, several years. So, the key driver here is the reduction in credit. So China used to just create so much debt over many, many years, and that was creating currency. That ultimately should weaken currency. But as they retrench, as this credit decreases in size, you could, because there's fewer renminbi about, you could see appreciation of that currency. It happened in Japan in the 90s and early 2000s. Most people thought the currency would weaken, the yen would weaken over that period, but actually it appreciated. And I wouldn't be totally surprised if China had that same theme over the next few years.
You know, Ben, you're probably some consolation here. You may not be totally crazy for buying 10-year Chinese govies, right? Because they probably are a safer bet than Chinese credits, would probably be fair to say. What about, and this is going to get interesting, right? Not that long ago, we talked about EM high yield, HY. What we actually meant was Chinese property developer high yield. Obviously, the weighting, that's been totally rejigged right now, but how do some of these Chinese high-yield credits look, the property developer ones? I mean, are any of them worth the risk?
That's still really difficult part of the market. I mean, for the private developers, they're mostly wiped out. I mean, so it doesn't really matter what you think because they're worth very, very little. Yeah. On the government-owned, the state-owned ones, I mean, that's the crucial aspect. We're all looking at Vanke, aren't we, to see how they go over the next few months, if they survive or not. Hopefully they do survive. They draw a line in the sand and say these are the ones that are going to go forward. And the Chinese government are obviously trying to support the property sector, trying to support consumption going forward. And this is going to be a real crucial test. So hopefully that will stop the rot.
Yeah.